Welcome back, everybody. It's another episode of Bold Real Estate Investing. I'm your co-host, Chris Angel, here with your host, Bill Dean. Hello, Bill Dean.
Hello, how are you?
I'm good. We got some hand jive today.
I see that.
Which I like. We're talking about winners today. I like it. I like talking about winners.
Absolutely.
Which, at the time of this recording, we're sort of in the beginning of 2019. But sometimes hindsight gives us perspective. Yes, that's why we're going back to look at 2018 and why was real estate investments the winner in 2018. So, Bill, a penny for your thoughts.
All right. Well, I hope you got 3 or 4.
Yes, I will depends on the value. If you give me really good value, I'll give you all sorts of dollars.
All right. Well, why was real estate best in 2018? I mean, someone could argue it's always the best.
In terms of investments.
Yeah. Okay. But, I mean, every year is different. I just attended a class where a professional investor, I mean, we're talking, she does over 100 deals a year, out of Texas, was just talking, hey, I had this new development that they're building and talked to their friend about investing. He's like, oh, no, I'm good. I made 20% on my stocks so far this year.
Right, because people are thinking, wow, 8%, they would say in stock markets, like a good return, like 8%. He's like, oh, I crushed it with 20%. Okay.
And then that was in August. Mm-hmm. And in November, December, she got a call from him. Hey, so I'm back to where I started 2018 with my stocks. I think I'm ready to look at your 12%.
Oh no. That's the thing about stocks. They can go up or down depending on the emotion of the market.
Exactly. Yeah.
Like tomorrow, bam, it could drop and you'd be in trouble.
Oh yeah. What did the president tweet today? Oh gosh, stocks right. falling. What's China doing? Oh no.
Right. Yeah.
Yeah. No, it's a little more skies falling there, but
Right.
So what I kind of looked into and why I yet again prefer real estate is it's just got some good long-term trends. Mm-hmm. Now, for whatever reason, 2018 ended where real estate was on top as far as investment. Just because 2018 started strong in stocks, but it really went away at the end. And so what's cool is according to gotta make sure I have the right place for you.
Yeah.
Marketwatch.com. Have you ever heard of that?
Yeah.
Okay. So they're just looking at all the different classes. So technically this is still a stock class.
Okay.
But the number one performer last year was REITs, real estate investment trusts.
Interesting. Got it. Okay.
So now they play a crucial role in real estate investing because when it comes time to maybe sell your portfolio and you just want passive income completely, you don't really actually even want to own the brick and mortar. You cannot do a 1031 exchange, which is a tax deferred exchange,
right,
outside of real estate. Right. But in some places you can actually do a 1031 exchange into a REIT.
Really? I didn't know that. You can.
So, yeah. So if you are, let's say you have enough income coming in and you don't want that tax burden of selling, $800,000 portfolio of paid off real estate,
right,
which you then get taxed at 25%, 20%, $160,000 loss, you could roll it into a REIT. So you keep your value, depending on the value of that, but now you're making that 6, 7, 8% return.
Can you also then take what you rolled into a REIT and 1031 back into a property down the road, like a normal 1031?
I do not know. I've never actually had someone do that. A lot of times.
That'd be cool. In the rules of 1031s, right, you can always keep moving your money up the ladder. But anyway.
I'll have to look into that part.
You guys listening, I'll have to talk to your 1031 attorneys on that one. But
exactly. Yeah, because most times
really cool, though.
Someone's selling their portfolio and they still want to keep some income coming in, but they don't want to get that tax hit because.
Yeah, got it. When you say that real estate won at the end of 2018, came out ahead of stocks. 2018 started with stocks, but real estate kind of won in the end. Are you talking about appreciation or what's the metric on that?
It's actually going to be ROI. So what was the average percent yield?
Got it. So if I invested X amount in my stock portfolio versus I invested X amount in real estate, you would have had a better ROI at the end of 2018 in real estate than you would have in your stocks. Same amount invested. Yep. You would have came out ahead in real estate. That's
and even within stock, the REITs outperformed everything else.
Got it. Okay. Yeah.
So it was it's kind of ironic that even in stock, the real estate won.
Right. Yeah. Right.
That changes from year to year and all that, but it's just kind of a fun recap of 2018 because people are still buying a lot of rental properties. I mean, people are still renting. They're putting up huge megaplexes in my area. They still are because affordable housing is so hard to find in a lot of markets.
Right. I was going to say, like, when appreciation happens and you sort of outprice the average income or the median income, all of a sudden people can't afford to buy the house, so they have to rent, right?
Exactly. Yeah. So, I mean, the REIT thing was kind of neat to see because the average yield they said was 4.7%. So that's the growth of the stock itself. Yeah. So if you invested in a $10 stock, you now had, $10.47. But I mean, it's growth. It's a positive thing. It's a positive return. Whereas a lot of things, the biggest, it's bad to say in my state, but the biggest loser was oil.
Oh yeah.
And,
right.
We're number 3 or 4 in oil production right now in the country. But so that's kind of one little nice kickback that real estate's working. Yeah. The metrics are working. And then some of the things that I'm seeing, and it's kind of actually worrisome, is what do most people tell you to put your money into? Like, if I were to say, hey, you should invest, where would you go?
Probably a financial advisor, and they'd put it in some stock or mutual fund or something, right?
Yeah, 401k, right?
401k, yeah, right.
Hey, put it in a 401k.
Right.
So I just found out that the average American who has a 401k only has $106,000 in it.
Wow.
So that's coming from Fidelity.
Okay.
And they're saying 106,000 is the average. And of course, it's more by age. But as far as 401ks work, the goal is to keep the majority of the principal there and to live off the interest when you actually retire.
Right.
Well, if that's only 108,000, let's say you get a 3% disbursement, $3,000 a year. That's $200 and some a month to come in to help you afford living once you're done.
Yeah.
So
that's tough.
Yeah, that's extremely tough.
Yeah. This is why I liked real estate investing years ago when I read Rich Dad Poor Dad. It was like when I could see that, if you're going to buy $100,000 of stocks, which is what you just sort of said with your 401k, you put $100,000 into your 401k. That's cash you put in. But you could have $100,000 property and only put in $3,000, $5,000, $20,000. And then over the course of 15 or 30 years, it would be paid off. And you had put, if you had rented it, it wouldn't have even been you putting cash into it. It was your tenants, right?
Exactly.
So I loved that and the appreciation I feel like is better and more stable. I'm sorry. I feel like I'm doing your job. I'm not trying to step on your toes. I'm just I'm excited about how real estate works that way.
Exactly. You're doing great actually, because you're taking it down a fantastic path because that's the truth of it. I was just talking to some people this morning actually, and investing in Main Street versus Wall Street. It's like, first of all, you can leverage real estate. Right. You can't go get a loan to go buy Walmart stock.
Right. Yeah.
Funny how that works.
Yeah, you can't refi your 401k to buy another 401k, right? You can't be like, I'm going to get 2 401ks if I just refinance my first 401k.
That'd be perfect.
Yeah, but you can't do that, which is really weird in some ways because it's all cash in your 401k. Like that's a lot of capital, a lot of equity, a lot of resource, an asset, right? But and isn't it funny that people are actually willing to give you a loan on something you don't fully own in real estate? Like you don't own 100% of that property. The bank owns 80% of it, but they're willing to, depending on how much you own. Anyway, you get the idea. Like real estate's way more flexible. Yes.
And the other fun thing is, can you get stock insurance?
What? I don't think so. Right. So like if you lost it all in the recession, there was no insurance that had you get that back. Is that what you're saying?
Exactly.
That might not be a great example, but tell me where you're going with that.
Well, I'm just saying, like, a lot of people ask me, like, well, what if it gets trashed? What if the unit gets trashed? What if it gets flooded? What if there's a fire?
Right.
Well, it's insured.
Right.
So I might have $1,000 deductible, but it's going to get fixed. And I don't skimp out on insurance because I do believe it's important to have because This is real life. There's no, I invested for 20 years and never had an oops. Like, let's be real.
Right. Yeah.
You're going to find that flip where, oh, by the way, after you fixed it, the sewer line is completely shut and you have to dig up the backyard. Goodbye profits.
Yeah.
You know, like, things are going to happen, but it's just being smart so that you can minimize those and be prepared for when they do.
Right.
And one of those things is like, okay, if I could buy a $10 stock and it goes down to $5, but my insurance will cover, $4 of that. Cool.
Right.
Houses work like that.
Yeah. Yeah.
So there's a beauty with that part too. But yet again, that's just some of the things that are really helping the industry, in essence, go and be stronger, is because it has these protections. Because one of the things I want to really cover, and it's kind of hiding in this episode, is just the fact that most of us we're the TV and everything. A lot of media has us believing that we can't invest. Like, it's too complicated. Like, you need to give your money over to these financial advisors, and they're gonna have a fee, and then what they buy has a fee. But at the end of the day, it's better than if you had tried yourself.
Right.
And
I've heard that. Yeah.
And one of the things is that costs money to try, versus real estate. There's a lot of free resources out there. Bigger Pockets is free. There's
the podcast.
Also, the podcast and their website.
Sure.
There's all sorts of information. I mean, you can literally just Google just about anything. Like, how do I calculate ROI? There's going to be a free website for that.
Yeah, you can't really do that in the stock market. You're going to be like, what's my ROI on this stock? Because you can't, it's too regulated. You can't, first of all, people can't tell you because everybody's afraid of an earnings claim and afraid to say, I can't tell you what your stock's going to earn. I can just manage it for you and try to put it in the best, paper assets possible, but they can't predict that for you.
Exactly.
And so you can't go research it because you don't have your Series 7 or your Series 9 or whatever other certification you're trying to get. And even if you did have that, doesn't mean doesn't act anyway. I'm on a soapbox, but yeah, you're right. There's a lot of information that can help you, including your show right here, right? Like Bold Real Estate Investing. Like, go back through these episodes. There's so much stuff that, and not just let me say this too, because I have a marketing agency. What we do is we actually help people create content. What I want to say to you listening to this is there's all sorts of content. And at some point, content isn't enough. Like, at some point, it has to turn into a conversation with somebody who can help you take that content and put it into action, right? Like, that's just the reality of it. I've consumed so much content in my days, and it actually sometimes makes my head spin, right? And then paralyzes me instead of puts me in motion. And so you just, in your content gang, you want to find the right people. Like Bill and I having this conversation. If you connect with Bill's stuff, you actually want to reach out and have a conversation with Bill, because that's what moves it from just insights or concepts into actually action in your life. Anyway, I had to say it, soapbox.
It's all right. Because to add to that, in fact, I'm using this in my presentation this weekend. And it's from Chaz Wilson, actually, which you might know.
Yeah, go shout out to Chaz Wilson. Yeah.
And the cool thing about it is he said, information is power, but the right information enables you to act.
Yeah.
And that's the biggest thing.
Yeah.
When you're out looking for information, regardless of what you're investing in, I'm pro investing. Learn for yourself, take control, get somewhere new. Right. But, you can get stuff and learn, but if it doesn't teach you how to take that next step, it's not that useful.
Yeah. Yep. That's beautiful.
So we'll have that little soapbox there.
I know, right? It's a soapbox session. Well, listen, let me sort of wrap with this. Like, if you had to, we're talking about 2018, real estate was the winner, right? Yep. What is the takeaway from that? Go ahead.
Yeah. So here's what's nice. Here's kind of the bigger market trends. We talked about the future 2019.
Yeah.
But how 2018 ended up is we had a really, really solid equity year. Meaning most markets were stable. Some of the biggest areas actually saw a little price decline. But that's not even that detrimental, because if you had your house for 2-3 years in that market, unless you went out and got a loan and borrowed up against it up to your teeth, you should be okay.
Right.
But equity is strong, which means what they just did, or what I just read literally, again, was that now a lot of cities are back to the 2008 pre-crash.
Mm-hmm.
Now it's not about digging back out of the hole. Now it's growth. Where can we go from here?
Mm-hmm.
So that's a very positive trend. That means value should hold fairly well.
Mm-hmm.
Of course, your top end is having a little bit different issue, but most investors who are in the D, C's, B classes, from kind of the scary neighborhoods to just, normal middle income type houses. That means if you're fixing a house, if you're buying rentals, if you're buying single families, they're going to keep going up in value, not by leaps and bounds, but stable.
Right.
And that is going to help when in 7 years, let's say, or 10 years, you're ready to jump a portfolio. And hey, we're going to go from single families to a couple big multifamilies. And then, hey, we're going to go from a couple here down to here. We're going to get into the resorts or this type of thing where you have whole different ball games. But it's nice knowing that, oh, by the way, I have to have so much cash flow because I'm losing equity. So that's what I wanted to hit on, is the fact that equity's out there. So if you're looking at investing, you can look at your own house. Hey, maybe I have a lot of equity in this. Mm-hmm. Maybe I can leverage some of this to give me that earnest money to go find a deal and sell to the next flipper. Or maybe I can buy a second property with the equity in your house, where you don't want to take all of it, but know you have some and you have enough for a rainy day, but that property is not only going to pay you cash, but it's also going to give you some equity.
It's really good.
So that's nice to know. We're in the right ballpark right now.
Yeah. It's good to know too, because you could feel I've heard the whisperings of, wow, market's been so strong. The real estate market's been so strong in a lot of cities for a handful of years now, with crazy amounts of appreciation, that people are like, well, are we in a bubble? Are we going to have a correction? But just to know, like, it's still a good time to invest because the value is stable, right? And depending on your market, there's still likely some appreciation that can happen, right?
Yeah.
So don't be scared. If your market has been really strong, don't be scared of the real estate market. Like that means it's strong. It's good.
And here's the best part. And I heard this, I think, on my first ever kind of like teaser real estate class. I had a gentleman up, I think he had like 300 properties. He's like, I invested through 2008 and 2009. And he said, so what happened to the value of my properties? Cut by half. Mm-hmm. Guess what happened to my cash flow? Nothing, because it was wrapped up in 12-month and 2-year contracts.
Wow.
Guess what happened to my principal reduction? Stayed the same, because that's wrapped up in 15 to 30-year
mortgages. Right.
He's like, so really what happened? Nothing. The value
because then it bounced back, right?
Yeah. So
wow.
Cash flow stayed the same. Principal reduction stayed the same.
So good.
Technically he might have to hold on to a house longer, but he wasn't going anywhere.
Yeah,
so
good. Yep.
So that's the beauty of it is, you can still win regardless of what the markets are doing. You just got to be smart. Don't over leverage. Don't take out too many loans based off each other. But it's there. We can go out and we can win.
We can win. That's right. It's so good. Well, and I think that's why it's so good to have a conversation with Bill. If you guys are listening to this and you want some help, right? I mean, listen, I'm all for the independent, like I can do it thing. And sometimes if people have just been a little bit further down the path than you are, it just helps to have that conversation. So Bill, if people want to reach out to you and talk to you about their plans and get your perspective, like how can people reach you?
All right. Just go to my website, BillDeanHomes.com. So it's just my name, homes.com.
Yep.
Click on the comments page and write me a message. Tell me what you're looking for, where you're at, and we'll see if we can't find a good strategy for you to get started or to improve or to take your game to the next level.
Yeah, I love that. That's great. Thanks for adding that. Awesome, man. Well, great episode. Thank you. We'll catch you next time. And until then, take care.
All right. You too.